Welcome to You Ask 502, the podcast where real stories meet real skills from the plumbers, pipe fitters, and service techs of Local 502. With over 25 years in the trade, I've seen a lot, and I'm here to bring those experiences and yours to the mic. We'll cover everything from technical tips and union updates to job site stories and career advice. So subscribe, tune in, and be part of the conversation. This is You Ask 502. All right, welcome to our next episode of You Ask 502. This week, coming in, we got like a little minor celebrity here. This is our fund attorney, Dennis Johnson with Johnson & Crow. How you doing?
I'm doing really well. Thanks for having me.
So this guy's always the smartest man in the room, and I do really appreciate that. And he is really good at explaining to the layman's the critical information that needs to come out. So I greatly appreciate that.
I appreciate the compliment. Not sure I deserve it, but I'll try.
So I guess we'll just jump right into it. So Dennis works on all our pension funds, our pension, our 401k, health and welfare. I think you also kind of do some work for the UA as well in that capacity. So
we represent, we do some UA work, local counsel directly for the UA, but they have us work in local counsel in areas where their law firm isn't licensed.
Okay. Do you do any other union locals?
Yeah, we do UA locals all over the Midwest, state of Ohio, Illinois, Wisconsin, Kentucky, Indiana. We represent locals across all sorts of construction trades.
Yeah, and it's not just UA, it's also, I'm sure like iron workers,
electricians.
But you do the iron workers here in town, right down the street?
Yeah, and the carpenters.
Okay.
That we represent the district council here.
All right. It's got a busy plate. So
yeah.
That's good. So, all right. So, well, I just kind of prepared some questions here to kind of go through.
Oh, I got to say, I can't forget my laborers here in Kentucky.
Yes, sorry about that. No disrespect to the laborers here in Kentucky. What exactly does a fund attorney do in real life? Like, what would your day-to-day operations be?
Well, 90% of it is pretty boring stuff. There's a huge regulatory environment for ERISA funds. So we have to have plan documents, appropriate notices. There's all sorts of reporting forms that go to contractors, participants, the government. Our primary job is to make sure all of that stuff is done in accordance with law. So it is a lot of paperwork. It is a lot of compliance. There's a lot of rules on how member benefits have to be paid in accordance with plans. So we do a lot of analysis of whether or not the claims are being paid or are payable properly. And then there's a lot of notices that have to go to participants when their claims are either approved or denied. We're involved in that a lot of the times.
Okay.
And then on a higher level, negotiating your contracts.
Yep.
Anytime you're dealing with a vendor, it's usually our job to get the best contracting in place. When vendors don't do their jobs, it's our job to
go after it a little bit.
Sometimes the contractors don't pay on time, and it's our job to make them pay.
Yeah.
It's really a long list of things. There's also a million negotiations that we have to do with people that deal with your plan, all the other vendors, other plans sometimes. It's really whatever you guys throw at us at a daily basis. Right. We end up having to be one of the primary providers of it. It's a lot of paperwork. My job, thankfully, as the managing member of the firm, is a little less paperwork oriented than it
more
used
delegation than it used to be.
I generally have to manage the firm and make some of the big decisions.
So that's why your name's on the building. Well, I'll jump ahead a little bit just to kind of help, segue into this. Well, I was going to say, what is ERISA? Kind of explain that. There you go. Explaining ERISA like I'm a 12-year-old to the people out there.
So ERISA was passed in 1974. It's called the Employee Retirement Income Security Act. So I was 3 years old when it passed. Essentially, before ERISA, plans like your plans were run pursuant to state law. And that law is ancient. It's ancient trust law. Right. So if you have an estate plan for your kids, or that trust law is essentially the same law that would have been used to run these plans. And it would vary state by state.
So ERISA is, I guess Taft-Hartley is where we come into like the unions, but ERISA is just pretty much trust law. Is that what you're trying to say?
Yeah, ERISA would apply even outside of a union context. Okay. Anytime an employer provides benefits to their employees, the Employee Retirement Income Security Act applies. And generally it was passed in 74 to try to protect employee benefits. So the idea was we're going to pass a national statute that creates a regulatory framework for how employees can provide benefits to their employees and all the rules they must follow in doing so. And generally it follows trust law that dates back to the English common law. It's thousands of years old. Obviously, it's a codified statute, so it doesn't follow the old common law rules completely. but that's what it's generally based on.
Right.
But essentially it means that when you promise an employee a benefit, you're required to put the assets for that benefit in trust, you're required to create a written document that says who's entitled to what, and you're required to follow that written document.
Easy enough. Good legislation. So is there anything that keeps you up at night about pension and health funds? Anything,
The big thing that is affecting our world and the country,
Mm-hmm.
Everybody's at each other's throats over this, is
yeah.
health costs. I have a lot of thoughts on the topic, but typically we're going to see our clients get raises in their total package somewhere between 3 and 5%, depending on the circumstance.
Right.
Sometimes as low as 2%, but generally between 3 and 5% is going to see what the packages go up. Health cost inflation for my entire career, I've been doing this for just about 30 years. And for the entire nearly 30-year period, health cost inflation has been over 6%, most periods over 7%. So it doesn't take a genius to determine that that's going to be a problem. If the underlying U.S. economy is going to grow at 3%,
Mm-hmm.
the health costs are going to grow at 7%. Slowly but surely, health costs are going to swallow the economy.
Yeah.
Now, some of that is expected. We have an aging population. We have a baby boom generation that is by far larger than any of the other generations that are aging out. And as you get older, you have more medical expenses. Seems obvious. So part of that is a demographic thing, which that demographic issue will sort itself out, right? Maybe it'd be great if we could live forever, but we don't. So eventually that active worker to retiree ratio is going to start to balance out. But that's not most of the problem. That's some of the problem. It's not most of the problem. Most of the problem comes from just a general distortion of the healthcare market. I always like to use an example. If you go to Walgreens or CVS, whatever your favorite pharmacy is, there's usually a wall somewhere in the pharmacy. If it's a Walgreens, usually the wall's on the right-hand side, and everything on the right-hand side of that wall is highly controlled by regulations, and everything on the left is very unregulated. And there's some. The FDA has some inspections for potato chips. Relatively speaking, you don't need a license to sell potato chips. Right. You don't need a license to buy them. You just go buy potato chips. And generally, everything on the left side of the wall, lately we've experienced quite a bit of inflation in the U.S. economy, but no one would say over the last 30 years it's been expensive to buy potato chips. It may have been more expensive lately, but generally speaking...
Still within the wheelhouse of purchasing.
Yes, it's certainly well within the normal growth of the U.S. economy. It hasn't grown in excess of what you would expect it to grow. Everything on the right side of the wall is just crazy expensive. Okay.
Yeah.
And we just have a lot of distortions that just keep building on themselves. And, I can get into it later. There's probably some things we can do, but it's going to be very difficult to get any of that stuff done. But the challenge of the next 20 years is going to be, how are we going to pay for all this? Because members don't like paying higher co-pays and deductibles, but every year the costs go up 7%. So money's got to come from somewhere.
Yeah, there's a lot of factors to that,
yeah.
For sure. A lot of people really don't want to do what they need to do to stay healthy, and then, of course, you get preyed upon pharma for that. So, crazy stuff you've seen, without saying any names. You worked on Taft-Hartley funds for years. What do you think was the wildest or funniest situation you had to untangle? Names, obviously.
Yeah, I won't put a name in there, but we did have an administrator hauled out in handcuffs one time.
Really? In a meeting?
It was in between meetings.
Wow.
A recently hired new administrator for a client. They were making fake invoices from vendors.
Ballsy.
And pushing them through the payment system. And at some point, I think an auditor from a prior employer figured it out. Luckily, my client never lost any money because they had got caught from a prior employer. Feds showed up and hauled them out of there.
Not for that guy, but yeah, it's actually yeah. All right. Trustees versus attorneys. So, who's really steering the ship? So, I'm a trustee. You're an attorney. Obviously, we do default to your guidance often, if not almost all the time. But
you are the boss, not me. So, but ultimately, my job is to advise. In practically speaking, I try to stick to advice that I feel very confident about, and I think our clients, know that when we say things, we're trying to support the general direction the trustees are looking to go. So I'm looking to the trustees to try to show me what direction the trustees want to take the plans. And then my job is to try to facilitate that in, a very efficient and legally correct way.
Right. Which is, like I said, really trusted what you always had to say. I think you could tell where I was trying to go with things at certain times. I felt like you were always trying to push the plan in the right way for the members, but also trying to cover our ass so we didn't do anything stupid to end up what got us here in the first place. And so
Yeah, I mean, when we first got hired here, I can't really go into a ton of details, but when we first got hired here, the plans were not in great shape, and there were a lot of For me, it was a very rewarding experience because what would you call it? If you're a military, my son's a military pilot, a target-rich environment, meaning there were a lot of value that I could see everywhere, value that I could bring to the table where we can make some changes to really save the members a lot of money. And over the years, the trustees have been great. We've worked really hard with the trustees to bring all that stuff to bear, and your programs have gone from challenge to really, really well funded at this point.
Just even what we talked about earlier when you pointed out the chart. So today we had newly elected alternate trustees sit in. Justin's were there, and actually Dennis did a good job explaining them, with the chart. And I won't give numbers, but even in years where we paid a lot, we still made a lot. And there's a lot of value in that. It's really hard to explain without saying the numbers in the chart, but we've grown, exponentially since 2014.
Yeah, I think you have almost double the assets since 2014, and this was during a time that you paid a lot of benefits.
Yeah,
so
a lot of benefits. A lot of people retired. COVID was in there. There was 3 years where it's kind of Wild West. But it's been really good. We've actually looks like there's light at the end of the tunnel.
Yeah, your pension plan after many, many years. I have to go back and think about what year. I remember I attended a union meeting. I think it was at the Carpenters Hall or wherever you guys have larger meetings.
Teamsters Hall.
Yeah. That's it.
That was right before I was running. There was a lot of people trying to.
My impression of the meeting was very positive. I mean, I totally understand why the members were. This was not great news. So I can see why people would be upset. But since that time, we have really turned this thing around.
Oh, yeah.
Things are really looking good. And unless there is some sort of very significant economic event.
They call those black swans.
Yes.
The red post.
Unfortunately, you cannot predict economics.
Right.
You don't know what the markets are going to give you from time to time, so they can always give you something unpredictable. But if we get even modestly bad years going forward, your plan is really well positioned.
There's enough data over the century to kind of, feel confident to make a 80% guesstimate. Like I said, there's always, for the most part, I think we feel pretty good. What do you think the most misunderstood part of our health fund would be? Like, what some of the members get wrong about it?
So this is one that I bring up all the time when I, doing what I do for a living, when people complain about health insurance companies. I always end up getting into arguments. I probably should just keep my mouth shut, but I end up getting into arguments with people. Because people want to blame the insurance companies for everything that goes wrong in the insurance market. Your plan is not insured. Your plan is self-insured. So you use a network. You use the Anthem network.
Which is what our fees are. We pay to just coattail their network, right?
That's
it. We actually pay for everything out of our own funds.
Yeah, so you're just renting their contracts with providers so that you get the discounts that they negotiate. But you're not an insured plan. You pay your own claims, which is...
Most people don't know that.
No, people don't know that, and they don't understand that the concept of insurance is driving health cost inflation. But it's not really the insurance companies themselves. The insurance companies keep what's called a retention. So they're going to say, this is what, if you buy health insurance from an insurance company, what they're going to do is they're going to put you in your age and gender bucket. They're going to say, this is what an average person of this age and gender costs. And then they're going to add what's called retention to it, somewhere around 20 to 25%. Retention is their profit margin. Right. There's no reason to be in the insurance business if you're not going to make money at it.
I think 20% is the most they can make.
No, I think that's generally what they're targeting.
Okay.
But, any particular year, they can do better than what they're targeting.
Well, yeah, that's what they say. The trick is to raise everything from the bottom up that way.
But the reality is, in a plan like yours, you're not paying insurance company retention. You're keeping that money for yourself. So you don't pay, they make a profit off of you renting their network, but that's a relatively tiny portion of your overall spend. Yet your expenses still go up at the same pace as everybody else's. The underlying inflation it's really caused by the lack of market dynamics in the healthcare world. If I go back to my example on the potato chips, if Walgreens tried to charge $50 for a bag of potato chips, they would sell exactly 0 potato chips. And then they would quickly realize they have to lower the price of potato chips because you would go across the street and buy them at the local grocery store.
You could only buy chips at Walmart.
Well, let me change the example. What if it wasn't your money that was used to buy the potato chips?
That's a good wrinkle there, yeah.
Okay. Ultimately, the free market only works if you're using your own money. Because if you're using somebody else's money, your decision whether to consume the product really isn't changed based on the price that's charged. So you can't really expect the market to correct pricing because demand isn't affected by pricing. If Ford tries to raise the price of an F-150 by 10%, it's going to drive people to Chevy because they're using their own money. But let's change the example and say your employer paid for your car and there was no limit on what you could buy. There'd be a lot of Lamborghinis sold.
That's true.
All right, and that's the general thing that drives these costs. It's the concept of the fact that you're using other people's money generally to consume things that you're using. That means that the market doesn't really do what it normally does, which is
adapt to supply demand.
Normally, you have a supply and demand curve that intersect, and the more you charge, the less you sell. But in the healthcare world, there really is no impact. You sell the exact same amount no matter what you charge.
It's genius, actually, but it's kind of a bad deal for us.
Yeah, and I mean, that is why things get out of control. And then the other one I would say is, I don't think most people understand that 75% of what goes into your health plan is spent on 15 to 20% of the people. And it's not the same people. The reality is most of us on an average year are pretty healthy. Most of the time you go a whole year without having any serious illness. And in most cases, you'll go most of your life without having too many serious illnesses. But not many people go a whole life without having a serious illness.
Enough of those people hit it the same year.
Yeah, and once you have a serious illness, those are very, very, very expensive. And that's where most of your money goes, is for the handful of people who are having a really tough time this year.
That's the way to humanize it, actually. You say it like that, you can actually have way more compassion for the people who are going through a tough time. So,
yeah.
Because, when we do these meetings, we talk about belly buttons plan.
Yeah, the reality is most of the money is paying for things where people are having a very rough time.
To their own, really. The pension, how does it actually stay alive? Like if someone asks you how a pension stays healthy at 40 plus years, what would you say?
Well, it's actually kind of crazy the way the whole, if you think about how the actuaries used to do pension plans before computers, before they had databases and spreadsheets, they used to do this by hand back in the day. And they carry a liability for every single member of this plan and their spouses. They know the ages of every member, and they have life expectancies for every member. And they know how much each member has accrued in benefits, and they know how old they are, and they know when they expect. They have an assumption of when they're going to start receiving benefits, and they have an assumption of how long every member is going to draw those benefits. They know how much money you have invested. They have an assumption on how much you're going to earn on those investments. And they take all of this math and they figure out all these payments that have to be made for every single person who's currently vested a benefit in your plan. And they run it all to a present value. And there's a way to do, if you have any finance training, present value calculations are relatively straightforward algebra. You can figure out what the present value of every single member's benefit is in today's dollars when you build in this life expectancy assumption and then an interest rate assumption. The devil's, of course, in the details, because if any of these assumptions turn out to be wrong, whether you have the correct amount of money could be wildly off. The biggest one being the asset return assumption. If you assume you're going to earn 7%, but you only earn 5%, well, you're going to be vastly short of what you needed to pay all those benefits. Whereas if you had a 7% assumption and you earn 9%, well, then you're going to be overfunded and you'll have some extra money to pay out. But generally, that's how you do it. You're basically adding up what the present value of every single benefit you promised to every single person. And if you're 100% funded, that means the actuary is telling you that you have all the money needed to pay every benefit to the last person and their spouse and beneficiary dies.
It's actually, would you mind saying it one more time? Because I want people to really understand that.
So if your actuary tells you that you're 100% funded, your actuary is telling you that you have enough money on hand to pay every single participant and beneficiary their monthly benefits that you've promised them till the day that they die.
Really think about that, because that's insane.
Well, I always like to say, imagine your own personal life. What percent funded are you? It's not going to be 100%, right? Do you have every dollar that you need to buy everything you're going to need till the day you die? Like you hope one day you get to retirement, you will have that.
Right.
To be 100% funded is a big deal.
Yeah. And then, people always coming. We add new people every year.
To be clear, just because the actuary says you're 100% funded does not mean all these assumptions they use are going to be true. Because we know people this hasn't been true recently, but generally over the last 100 years, people keep living longer. Those life expectancy improvements add costs to pension plans. Yeah. So if the actuary has to go ahead and adjust the tables they use to add greater life expectancy, suddenly you can go from 100% funded back down to 90% funded because say there's some cure for cancer tomorrow. If they cure cancer tomorrow, life expectancies are going to shoot up a lot, in which case, it'd be great news, right? I'll hope that they do that. But
a lot of pension plans go belly up.
I don't know if they go belly up. They suddenly lose 10% of their funding.
Right.
And you have to come up with a way to pay for it. Yeah. And your retiree welfare benefits would become more expensive because people withdraw them longer.
Yeah.
Social Security and Medicare would become even more difficult to pay for than they are now. So The good news is we live longer. The bad news is we have to pay for longer retirements.
There's always a caveat. So being a fund professional, what happens when employers don't pay? I know you kind of regulate the employers. I guess when someone hears the term delinquency, what actually happens?
Well, the trustees have a delinquency policy. I don't have it memorized off the top of my head, but once a company is late a certain number of days, obviously there's a late notice that goes out.
Right.
And if that gets ignored after a certain amount of time, it gets referred to us for collection. We'll typically send a demand letter saying you got to pay this, plus you got to pay some liquidated damages and possibly some interest and attorney's fees if it comes in place.
So it's like a foreclosure or a repo. You get all the literature like, hey, we're coming, you need the money or something soon.
Yeah, we say you got to pay us or we're going to sue you. And if we sue you, you're going to, this is not typical for the U.S. legal system. Mm-hmm. Usually in the U.S. legal system, everybody pays their own attorney's fees. Okay. But ERISA has it on the table. ERISA has a provision that says that we're allowed to recover your attorney's fees.
Okay.
So we tell the employers that if you don't pay, we're going to sue you, and you're going to have to pay your lawyer, and you're going to have to pay our fees, which usually gets their attention. Yeah. And usually we end up negotiating some kind of settlement where we get the company back up to full pay.
Where our plan's made whole. I think you go after liquidated damages and attorney fees.
Yeah. In a perfect world, we collect enough money to, so that you get your money back and you can actually get your attorney's fees back too.
Right. Good deal. 401ks. Who actually controls the money? A lot of people think of 401ks like the Wild West, but are there rules, guardrails? Who's responsible for what?
Well, it's a little bit of both. So you have a self-directed 401k. So much of the responsibility falls on the participant, but much of the responsibility also falls on the trustee. So the trustees are obligated to properly vet and provide an array of investment options that meet the requirements of something called 404C. It's a section in the Internal Revenue Code that essentially we have to meet certain requirements of different types of investments. We have to do a prudent job of providing the participants a proper array of investment options that the trustees have vetted with appropriate advice. From there, the participants have a choice to choose among the approved investment options. So the trustees have a very significant role in approving the array of investment options that the participants get to choose from. And the fiduciary's job is to try to make sure that we're not allowing options that don't meet ERISA standards.
Right. There you go. It's a little too cavalier for what's going on. So, like we talked about today, there's someone who's retiring, or I guess Scott, for instance, right? He's retiring soon, so he would be on the 2030 plan, I guess would probably be the closest because they go in decades, right?
Oh, yeah, the target date fund.
The target date fund, yeah. And which is a little more easy. You're at that point, you're trying to just save money. An apprentice who just got enrolled would be like the 2070 plan, which is let's be aggressive with what we have to kind of build it.
Yeah, so the target date funds are your default investment.
Right.
So the trustees are allowed to have what's called a qualified default investment alternative, right. A QDIA. We always have to have acronyms in our world. Your target date funds are your QDIA. And essentially what they do is if you don't make any decision, so if you just show up, start sending money in, and you never make an election, you're automatically defaulted to the target date fund that matches the date of your retirement.
Valued engineering in our world. You know what I mean? It's like, hey, this is the plan we think is best for you, for your age. And like you said, it's been through, I guess tests and trials and tribulations to come out with what the best plan would be for someone your age.
Yeah, generally it starts out with higher equity allocations when you're young, and it very, very slowly moves the equity allocation down as you get closer to retirement. Never going, yours, I'd have to look at it. It probably doesn't take it much below 30, 40%, probably always stays 30, 40%, somewhere in that range. So it's never all in bonds, but as you get closer to retirement, it's going to want to move you away from equities more towards bonds, generally so that you have lower volatility.
Right. That way you don't lose a big chunk when you're planning on what you're going to have right before you go.
Yeah, and the biggest thing that I would tell somebody is you can still lose money even if you're in a pretty close to retirement. The big thing is just don't take out more than you need in a down market. If that makes any sense. You never want to sell into down markets.
And I guess real quick to that, that's a stupid question, but I think some people might want to know 401k and a Roth IRA. What's the difference?
Well, you can have Roth 401k too. Yeah, you can have IRA. You can have a traditional IRA, a Roth IRA. You can have traditional 401k or Roth 401k. I personally, at my company, do a Roth 401k. That's an election of contributions. I don't think we allow a Roth option in your plan.
We just have an IRA.
You just have a traditional
pre-tax or post-tax.
Yeah, you have a traditional 401k, which is pre-tax, but it is legally permissible to have Roth contributions to 401k plans. But generally, Roth means you pay the taxes up front, and then you don't ever pay taxes again.
You still pay taxes because, and maybe I thought this was wrong. Like, it's still earned income when you get it out. You still have to report what you earn, right?
No, if you make a Roth contribution, there's no deduction on your taxes. That's treated as normal payroll, so you get no upfront tax saving. But you then aren't taxed on the balance in your Roth contribution account, including the earnings on that.
So when people 59 and a half draw that out, that's tax-free money?
Well, I mean, they paid the tax on it when it went in.
Right, but I mean, like at the end of the year when you get a W-2, you don't have to claim that money?
I don't believe so, no.
Okay. Because I always thought that was like the caveat. Like, I know it's not taxed getting it out, but I thought it was still like earned income.
No, that's the beauty. I mean, whether or not it makes sense to do Roth is a bit of a complicated math scenario because, the traditional, you have more money in there because you didn't pay the taxes on it. Right. And that extra money actually earns earnings.
Right.
And then you pay the taxes as you would draw it. But oftentimes you're not working at your job anymore, so your effective tax rate is lower when you're retired.
That's true, yeah.
Okay, so it's a pretty complicated math formula that I am not qualified to make.
Right.
To determine whether Roth's better or IRA's better. Some of it has to do with whether or not you think taxes are going to be higher in the future. Right. So a lot of people think taxes are going to be higher in the future, so they're betting Roth will pay it now versus later. I think it's hard to make, any bets on what the heck the government's going to do.
Well, that's true. Future of Taft-Hartley funds. Is anything changing? It's like in the next 10 to 20 years, is there a trend that members should be paying attention to as far as the healthcare compliance? I know cybersecurity is something.
I mean, unfortunately, cybersecurity breaches look like they're going to be the scourge of our industry for years to come. Yeah. A great deal of effort has been put in both by the government and by all the providers that work in our industry, the funds, the trustees, to try to prevent these breaches. The reality is, it seems like worldwide, the hackers are just always a step ahead of the defenders, which I guess fits if you're a history buff. If you want to compare cyber warfare to real warfare, generally the party that chooses the time and place of their attack has the advantage versus the defender.
True.
Because the defender has to defend everywhere all the time, and the attacker gets to look for vulnerabilities. So we have a series of well-meaning companies spending absolute fortunes trying to make sure that there's just no doors and windows open, but we regularly across our clients get breaches. Like all the efforts and money being spent.
And there's a lot of effort
and
a lot of money, yeah. You got good guys going to the bad side.
That and at some point something's going to snap with our healthcare system. We can't just keep throwing 7% a year, 7-8% a year at these things. So something's going to break nationally. I'm not sure what we can do to prepare for it other than just probably realize. I would make sure you stay in your 502 plans.
Yes.
Because however it works out, we'll likely be able to deal with it collectively better than we could individually.
If you could teach every member one thing, what's one piece of advice you wish every union member understood about our benefits?
I don't think the average union member, just to be clear, I got into this business because my dad was a union electrician. I mean, that's why I love this work. I try to do everything I can to do what's best for our guys who make this country run. While I'm sitting in an air-conditioned office, I try to do everything I can for you guys that are out there sweating and freezing in the heat, or sweating in the heat. While I'm sitting in an air-conditioned office, I try to do my best for you. So I mean this with all love, but I don't think our average member across our client base understands how much valuable their benefits are versus what a non-union or just normal U.S. citizen gets. I mean, it's not even close. It's not even close. The value of a typical construction benefit program is typically worth more than what the average person gets paid in this country.
Yeah.
So, some of our systems are worth $40, $45 an hour.
Yeah.
There's a lot of people that don't make that much on their check.
That's true.
Okay.
That is true.
And I also don't think people understand how low your deductibles, copays, and out-of-pocket caps are.
Yeah, that's we try to beat that point home, but I mean, we're still, I think, in the lower percentile of most.
You're not even in, if you're comparing you to other Taft-Hartley construction funds, you're probably fairly average or better. If you're comparing your funds to the private sector, non-union private sector, you're not even within shouting distance. I personally have a $5,500 deductible in my plan. So before my plan pays anything, I have to pay $5,500 out of pocket. And that's pretty typical in the normal world.
Right.
And I don't mean this, I only say this so the average member should understand that the reason these things are expensive is because they provide really high levels of benefits. And nobody gets retiree coverage. Normal people do not get retiree coverage. If you work in a non-union job, you are not getting retiree. I mean, I shouldn't say you're not. It's going to be very unlikely that you're going to get retiree coverage, and that's worth a lot of money.
Most people hang on to Medicare, 65.
Well, and you guys provide post-Medicare coverage to cover, Medicare only covers a certain amount. There's a lot of things Medicare doesn't cover, and you guys make up that gap too. A regular person that's in a non-union job does not have that. They're spending $400 or $500 a month out of pocket for their supplement.
It's the dumbest legal myth you've ever heard about pensions. The craziest misconception, I guess.
After the struggles that pension plans suffered after 2008, and really 2008 it really wasn't just 2008. The reason so many pension plans, including your own, got into financial trouble was it was really a 2-decade issue. So you ended with the 90s where, if you look at asset performance in the 90s, stock market returns were really off the charts in the 90s. So you had pension plans sitting on really incredible funding percentages at the end of the 90s. And if you remember what I told you earlier, they have these asset assumptions. You assume you're going to earn 7.5%, whatever your particular actuary assumes. And it's additive at the end of a decade where returns were just phenomenal. There were also what are called deductibility limits that I won't get into too much, but basically they said you kind of had to improve benefits because there was only so much that could be deducted under the tax code.
I mean, you couldn't be too overfunded.
It was a ratio of what the benefits were worth to what was being paid. There is still a rule, but the rule was changed so that it's such a huge number that nobody ever hits it. But back then, it was a number that was...
People met regularly?
Yes. Yeah. And, that was intended to keep these things from being tax shelters for rich people.
Well,
Okay, the reason they had that rule was that the government doesn't want, lawyers and doctors to create pension plans where they're just giant tax shelters. Right. So there had to be some relationship with what you're paying to what the benefit is promised. Okay, so you ended up with this high asset values, and then you ended up with both the dot-com burst of the bubble, and then you ended up with the 2008 financial crisis. And financial crises are always worse than all other crises because if you're a student of economic theory, when you deleverage, when you have a banking crisis, when banks loan money, it has a multiplier effect in the economy. It's hard to explain this in simple terms, but anytime a bank loans money, it essentially takes the same dollar and it recirculates it numerous times. So when you de-lever banks, all sorts of dollars disappear. All those dollars that were getting levered multiple times out in the economy start to disappear from the economy. So banking crises are always worse than other type of financial crises because all this money starts to disappear. So that was a particularly strong economic downturn in 2008 because it was the banks that were really getting hurt. And all that money unleverages out of the economy. I don't know if unleveraging is a word, but we'll use it. So you couple two bad losses within shouting distance with each other, and then all the promised benefits that went out when everybody was feeling, flush and generous. And it created a situation where these things were overpromised. So getting back to your question, what's the number one thing? In that era, we had a lot of people trying to compare pension plans to Ponzi schemes. And, pension plans are the furthest thing from a Ponzi scheme. The kind of math that has to be done to justify a pension promise is unlike just about anything else that exists in the U.S. legal system. There is a incredibly complex regulatory environment. Anytime you make a pension promise, you have to have an actuary certify a million things in order to say that you're actually funding it properly so that you're not making a Ponzi scheme. That doesn't mean you can't make a mistake and mess it up. That's different. You can overpromise and underdeliver just like anything.
Right.
But Ponzi schemes are always going to not.
Right. The whole point of that is to get you in the end. Where actually, I guess the intention of this is to follow through.
Yeah, and you've had challenges, but you're getting closer and closer to 100% funding as we sit here. While you've had some challenges, meeting your funding requirements, this is far from a Ponzi scheme. You have hundreds of millions of dollars sitting there for you to pay benefits.
Yes, and it takes a lot of money, like you said, to project out. I mean, it's crazy. All right, behind the scenes, how do trustees stay out of trouble? Like, what are some big compliance pitfalls for trustees? I've learned about a lot of this in trustee training.
I mean, you just named it. That's what I was going to say. Try to stay trained. Mm-hmm. Try to make sure you got to watch every penny, every dollar, every vendor. Make sure that we're all doing our jobs. Right. I, as the attorney, try to do some of that for you as well. I am trying to watch all your vendors, making sure they're complying with all your agreements, making sure they're giving you good advice, making sure that I'm not hearing things that are inconsistent with what I hear at other clients from other vendors.
I really appreciate that as well. I feel like you do call it out when you, or at least question some things, which I appreciate.
I mean, we try. My job. Ultimately, I work for the trustees and the trust.
Right.
So my actual client is the trust. So my job is to try to protect the trust. And I take that seriously. Say no different than you as a trustee. That's your job too. So, getting all the education, staying on top of things, making sure everybody does their job properly, making sure you're getting best in practice services. Those are the things you got to look for. Yeah. And then, when you have hundreds of millions of dollars, people are looking to try to figure out a way to take it. So you got to watch out for that.
That's right. Why are our funds structured the way they are? Why do we have separate? Like, why can't they all just be one big pot? Like the health and welfare, everything, and you kind of segregate it out? Because I guess theoretically, 7% on billions better than 7% on 500 million.
Yeah, I mean the simple answer is it's just the way the legal system works. So there's a tax code that allows employers to provide health benefits without you paying taxes on it, and that money has to be kept in a separate trust from the pension assets, which are qualified under a different section of the Internal Revenue Code. And your DC plan, your 401k plan, is yet another section of the Internal Revenue Code.
That makes sense when you say that.
So, you essentially have four funds if you include your apprenticeship fund, all of which are regulated under different regulatory schemes, which all take advantage of various tax breaks. So that's essentially why they have to be separate.
That's actually a good answer. Yeah.
And why they have, why they're called a Taft-Hartley fund is because the Taft-Hartley Act, which was passed in 1947, made it a felony for an employer to pay anything of value to a union official if it didn't meet one of the exceptions under the Act. And one of the exceptions under the Act is, there's a bunch of exceptions under the Act. All the times that money goes from a contractor to one of the trusts that the union officials sit on, or the union itself fit under one of those exemptions. One of those exemptions is for jointly administered Taft-Hartley benefit plans for the sole and exclusive benefit of the employees. That requires you to have half management, half union officials, which is why you have all of your trusts set up with a 50% voting control by the employer trustees and 50% voting control. That's to comply with the Taft-Hartley Act.
Jimmy Hoffa did this to us.
Yeah, that's arguably the case.
If you could fix
maybe not Jimmy Hoffa.
Why not Jimmy Hoffa?
There were some high-profile things that happened back in the day.
Some chicanery back in the day.
Let's not impugn the office.
Fair enough. If you could fix one thing about the U.S. benefit system, so if Congress gave you a magic wand, it was like, Dennis, make it perfect.
I've actually thought about this a lot. I actually have some fixes that would not be they would be very popular with the American people. I'm not sure they'd be very popular in Congress, but they would be very popular with the American people. I got a couple of easy ones. Drop patents from 15 to 5 years on drugs. You can't take it to zero, because if you made it zero, there'd be no reason to even make the drugs. Well, there has to be an incentive for the company to invent the drug, or they won't invent the drug. And there's lots of drugs that are very useful. There's others that maybe you can argue aren't, but certainly some of them are highly useful, and you're going to want those drugs to get developed. I don't know if 5 years is the magic, but 15 years seems massively excessive.
Too long. Yeah.
Yes. I think most favored nations pricing is something that you can put in place tomorrow. There's already an executive order on that.
I think that's coming somewhat.
There is an executive order on that, but it is in all likelihood not legal. So while it is well intentioned, the president likely doesn't have the power to do it. Congress does. So they're going to try, but this was tried in the first Trump administration. In my memory, the court struck it down.
Right.
So it'll likely get struck down again, depending on how they structure it.
Can it be an executive order, but then that would go away with the new president? It was a law.
I think legally the president doesn't even have the power to do it. It's something that's probably reserved for Congress, and that's probably what the courts are going to say again. So, most favored nations pricing is probably something Congress would need to do. My understanding is, don't quote me on this, but I'm not 100% sure, but I think Bernie Sanders is for it as well.
He is.
So, it seems to me that if the president and Bernie Sanders are both for it, it's something that should be able to get passed, but it doesn't ever even come up. My final one would be, I'd like to see a national regulation that allows healthcare providers, both hospitals, doctors, nurses, all types of providers, get licensed nationally versus state by state.
Okay.
Now, hear me out on this. I think if you created a national network of hospitals and or doctor networks, you trigger some competition that very likely could drive innovation and costs down. I think if Wall Street was allowed to invest in a nationwide medical network that tried to deliver healthcare in a way that was disruptive and cheaper, it might actually happen. But if you have to do it through 50 different state regulatory agencies, the incentive to do so is not as high. I'd like to at least see that tried and see whether or not you get some innovation, because it seems to me if you've had a loved one in the hospital, there's just a lot of paperwork. There's a lot of people typing on things. And it just seems that the ratio of hands-on care to paperwork is very low. And that strikes me as open to potential to do things much more efficiently, right? And if you did it more efficiently, then it wouldn't cost as much.
That's true, yeah. So many people got to touch it. Everyone who touches it has to get paid.
Yeah, and the goal wouldn't be to get rid of the jobs. The goal would be to take the same number of people and have them treat twice as many things. That would bring down the cost.
That's a good pitch. Common questions from members that I've heard. We can just do rapid fire. So, do unused benefits disappear?
Well, no. Are we talking in welfare or pension?
I guess either. Well, I guess the next question kind of is pension, so this would be welfare.
So, like I said earlier, the vast majority of your participants every year pay in vastly more is paid in on their behalf than what is withdrawn. You're going to spend, there's statistics on this, so take this with just sort of generally correct. Any person's going to have 80 to 90% of their own personal healthcare expenses over the course of their lifetime happen in one relatively short period of time in their life. Okay? So most of us are going to go most of our life with relatively routine care. Maybe some chronic conditions, maybe some chronic drugs you take, pharmaceuticals. But generally, you're going to not have a ton of expenses other than maybe a knee surgery or a hip surgery or something like that.
You're talking like overnight stays or something where it's like...
Yeah, it'll cost money, but it's not going to cost $500,000. And then at some point in your life, you're highly likely to develop cancer, heart disease, some sort of serious medical condition. There's cancer drugs out there that cost $1 million a year. There's hemophiliac drugs. Like, here's a great example of the modern medical economy. There's a type of hemophilia that is very rare. I think it's 1 in 3 or 400,000 births. There'll be a child with this condition. And there's a drug called Zolgensma that treats it. But the entire population of people who can be helped by this drug, Zolgensma, is like 300 or 400 people are born a year that this drug could help. And then there's another couple hundred adults that might get this disease. So you're talking about 400 to 500 people. This drug is, people that would otherwise die won't die if they take the drug. Now, it's not a cure, but if you take the drug, like, your loved one will be alive, and if you don't take the drug, they won't. And the drug costs, a couple $1 million a year. So all I can say is it doesn't disappear. It's everybody is paying for the handful of people who are going through the one time in their life where they're going to spend a lot of money, if that makes any sense.
It does, yeah. Yeah, you kind of explained that earlier.
Yeah. And it might not be you now, but the chances of any of us getting through an entire life and just dropping dead one day and not having a serious illness is very rare. Sure, it happens, but it's rare.
Well, to piggyback off that, what happens to pension money if you die early?
Well, it's kind of it's not the same thing. Pensions, the best feature of pensions is also the feature that frustrates people. So what's the best feature of pensions? The best feature of pensions are you get a monthly income until you die. Yeah. When are you going to die? You could die when you're 60. You could die when you're 70. Some people live to be 105. And your pension plan is going to write them those checks until they're dead. Yeah. And then you have a spouse. So if you have a spouse, then a certain portion of it, depending on what election you make, it could be all of it, goes to your spouse till they die. Right. That's the best feature of a pension plan. The worst feature of a pension plan is that if you die young, you only get the payments that you got while you were alive. But the reality is the way the pension plan pays for all this is some people live longer, some people live shorter. Right. Those things balance out in the end, and generally the life expectancy, when I told you earlier, the actuaries assuming when everybody dies, you'd be surprised at how accurate they get this.
It's insanely accurate. It's not done a full deep dive, but I've looked into it enough where it's
pretty much to the number.
Yeah. Yeah.
And
I don't know about the day, but they can probably get it down to the month.
And every time somebody dies before life expectancy, that tends to average out with a person who lives beyond life expectancy. Right. And ultimately, it's a pool. It's what we would call a pooled risk. So we're pooling the life expectancy risk. In a DC plan, people think about how the risks, the longevity risk works in a DC plan. It's all on you. Yeah. So say you have $500,000 when you retire in a DC plan.
Sounds like a lot, but you got to make that last.
Well, how long are you going to live?
Right.
And if you plan on spending the last penny when you turn 80, and then suddenly you're 80 and you're still healthy and your money's gone, what do you do? Okay, so you end up having to underspend it because what if I live too long? I need to make this money stretch. Well, DB plans pool that risk across all your folks so that the averages play out. But if you live longer, you don't have to worry about outliving your pension. So ultimately the answer is it doesn't go away. It goes into the pool that everybody uses for the folks that outlive it. And the goal of a pension plan is to let everybody retire with dignity. And I like to use my parents as an example of this. My parents were fantastic. But one thing they weren't great with was money. If you had handed my parents $500,000 when they turned 65, there's zero chance they would still have that when they were 70. Okay, zero chance. And a pension for most people is going to be a way where they're going to live their entire retirement with dignity, not just the first 5 years.
Does the health fund allow them to deny certain treatments?
I thought this through. Generally, I guess the answer is yes, but it's kind of a loaded question. We have plan rules. We have to follow our plan rules. And if you're getting a treatment that isn't covered by the plan for whatever reason, that the plan design has been designed so that this particular thing is not covered, such as say weight loss drugs. The trustees design a plan not to cover weight loss drugs, then yes, you're allowed to not cover weight loss drugs.
Because you have to protect yourself. You said the trust is who we work for. You have to protect the trust at all costs.
And it's just a matter of cost. Your plan's expensive. You can keep adding things, but then that just adds to the contribution rate that's going to be needed to pay the benefits. So It's just a matter of how much do you want to pay. The more you cover, the more that comes out of your paycheck. Yeah. So there's no right answer. There's just answers.
Dan, how does reciprocity work?
So the UA's got a great reciprocity program. Not every treatment.
Pretty recent. 5, 6, 7 years?
No, it goes way back. I actually am one of the few people that actually knows the whole history, just because I used to work on the reciprocity agreement that predates the UA reciprocity.
Is this the Chicago thing?
Yeah.
Okay.
So, I want to say, if I get my age right, the Midwestern States Reciprocity Agreement died at the 2000 UA convention in Miami, if I'm going to remember this correct. Prior to that, international reciprocity was, in really the whole country, was run based on a reciprocity agreement that was put in place by 597 in Chicago, called the Midwestern States Reciprocity Agreement. pretty much every local in the country, to my knowledge, signed on to the Midwestern States Reciprocity Agreement. It was a full benefits follows the man agreement. And essentially it was run out of 45 North Ogden, Chicago for decades. At some point, it became frustrating for some of the larger locals with high contribution rates to be sending very large contribution rates to locals that had contribution rates sometimes half of theirs. An idea was sprung to send the lesser of the two rates out, and an amendment to that agreement was circulated. That led to the discussion of reciprocity at the 2000 convention, and the UA at that point took over reciprocity. And now, since then, you've had, I don't know how long it took the UA to put together a replacement agreement. It's been too long to remember, but I think it took a year or two. They went around the country, announced their reciprocity agreement, heavily encouraged everyone to sign on to it. And since then, now the reciprocity agreement, it is a full benefits follow agreement.
Yeah, it goes to Annapolis and then back down.
Yeah, so, exactly.
Okay. Can the 401k be used for disability or hardship? Certain provisions in place.
Yeah. You have to meet the provisions in the plan.
It's got a pretty traumatic stuff, but hung out to dry. What does fiduciary responsibility really mean? We always hear the phrase, but what does fiduciary duty actually mean on a day-to-day basis for a trustee?
It means you have to make prudent decisions, and prudent decisions mean they have to be reasonable, what a reasonable person in like circumstances would do under those circumstances. And sometimes it requires you to educate yourself. So if you don't have sufficient training, it requires you to get expert advice. But essentially, it is a term that requires you to do the reasonable things in just about every circumstance you're making a decision. And if you fail to do what I can prove is reasonable, you can be held liable for failing to do so. It's a pretty high standard, because basically anytime somebody can prove that what you did is unreasonable, you're in theory subject to potential liability, which is why we put so much time into trying to make sure everything we do is reasonable.
And I guess the default, or the de facto, just always defaults back to the trust. I guess if it's a tie, kind of like a baseball tie goes to the runner, a tie always goes to the trust. I guess it's it.
If it comes to trustee versus the trust, it's not perfect, but yes, that's generally true.
Member horror stories, how to avoid problems before they happen. So without naming anyone, what's a preventable situation that you see?
I thought of three things. One of the most egregious things, it doesn't happen as much now because I think this message has gotten out, but it used to happen more often. It's members going out of network to providers, and I don't know if the member understands how big their liability can be, because the plans have a usual and customary rate schedule. So even though the plan says maybe we'll pay, I forget what your plan says, let's say 70%, whatever your plan says for out-of-network. You might think you're limited to just 30% of the bill up to your out-of-pocket cap, but the reality is the plans only cover up to a schedule, and these out-of-network providers can charge 2, 3, 4 times what your usual and customary schedule will allow. So you can end up with huge amounts owed over and above what the plan will pay if you're not in network. So, one of the biggest piece of advice I could say is just if at all possible, do not go outside of your network, because you can end up with a very large financial obligation.
Is that something that the member has to follow up on? Because I know that for surgeons or doctors or general practitioners would send someone for surgery. Hey, this is my buddy, and you would think you're in network because they take you, and you realize
you have to be careful.
That's what I'm saying. That guy's not in your network, and it's like, oh wow, this surgery's down toward.
Yeah, you cannot trust one provider to send you to another network provider. Generally, they will, but you need to always check.
Let's just call a benefit office and check. Say, hey, is this guy?
Yes, and Anthem has a list. You can consult the Anthem. You should always consult that. Yes.
Be caught.
This was one that my dad did. He started his own contracting company. And then didn't pay benefits on his own behalf, which sounds like a great idea until you go to retire, and then you don't have any money to retire because all those benefits that provide for that retirement with dignity aren't there for you. Mm. So it's easy to not understand how valuable those benefits are. Right. If you decide to open up a contractor's office, or if you go to work inside of a contractor's office, try to keep your benefits, because you're going to regret it later on if you drop them. Especially the retiree benefit can be worth as much as $250,000, $500,000. It's huge money, and people don't realize that you don't want to give that up. And then don't ever drop your retiree benefits from 502.
Think they have a better plan, or they go with, and sometimes I guess maybe, I don't know if you can say, get on government insurance.
It's usually because they're not understanding the networks. So when something's too good to be true, it almost always is. So sometimes when you go on the exchanges or someone's offering you insurance that's really cheaper, it's usually because they're narrowing the network. There's either higher deductibles and copays, or it's a very narrow network, so you can only use a very narrow band of providers that are very cheap. And if something serious happens to you, you're going to almost instantly not want to be in that band of providers. And you'll immediately regret being stuck in this plan and be like, what have I done?
And we've got people come back,
Generally, if you leave the retirement benefits, you'd have to come back and requalify for benefits as active.
Yeah.
Which, if you're 70 years old, you're not going to do that.
It sucks.
Yeah.
30 out of 40 months or something like that.
Yeah.
Previous. Yeah.
That's going to take a while. So, I mean, that's what, if I had a list, I'd say don't leave the union plans.
It's good advice. I know you got to get out of here. I really appreciate you stepping in here. We had our trustee meeting today, and Dennis was kind enough to come answer some questions.
All right. Thanks for having me.
Really
this was fun.
Awesome.
Thanks.
Y'all have a good one.
Thank you.